Um, all right, so let's quickly talk about some issues in LBOs. So we're going to discuss here why LBOs occur, how are the deals structured, how the venture capitalist or LBO firm can obtain the required rates of return, what's the real source of value. We talked a little bit about that, and we're going to go in more in depth. We're basically going to talk about whether or not LBOs represent an expropriation of shareholder wealth by management. Do they hurt minority shareholders? And this is mostly talking about buyouts of public companies. So at some point, there's some people who, after you get 52% of a company, what the other 48% want really doesn't matter. So the question is, are the people who didn't want the LBO to happen but couldn't prevent it, are they hurt? So. And so again, the types of LBOs, going private. So basically, this is a situation where the entire public stock interest of the firm is bought by management exclusively. And this is typically known as a management buyout. That's another way that it be put. So basically, what you have is the existing management of a company. So we go on Yahoo Finance, Joe Schmo, CEO, right? Tom Smith, CFO. Ginger Brown, Chief Operating Officer. So those people, right? Those people actually take their equity in the company, along with, maybe equity from an outside private equity shop or whoever, and they actually buy the company that they currently run, right? So in that case, management is not going to be replaced. They're just going to run the company and continue to run the company, but in a private, non-publicly traded context. And so that's important. I mean, the reasons that you would see it happening a lot of times is sometimes they just, for a large public company, it costs about $2 million a year just to be public, right? So if you're not so large when you definitely need to be public, and you're not, your stock is not really trading at that higher multiple that you should get for being public, then you start to say to yourself, well, why are we bothering? We're paying $2 million a year for a currency that's not even really paying off. So we might as well at least put the $2 million a year back into the business or back into our pockets, or certain businesses are negatively affected by earnings cycles, right? So when you have that analyst, at Piper Jaffray or Needham & Company or Morgan Stanley or wherever, right? Kind of, standing on your left butt cheek, looking over your shoulder every quarter, it can be daunting, and it can be tough because, if you don't make your earnings this quarter, then your stock drops, and, there's people who feel like the company's not doing well. Whereas you may have a plan as management that requires the long term. So maybe your earnings are lower for a certain period of time while you invest in the business, and you can really come out stronger later, right? So in that context, a public company structure doesn't help you, and you actually can do more things as a private company, without the entire world looking at every move you make. And so, again, going private or a management buyout. So, typical leverage buyout, the ownership is going to be basically held by, private equity firm, shared by management, and then third-party investors. And the financing usually takes some form of debt. So basically, in that situation, money is given to management, or a piece of the company is given to management, but that's not necessarily the existing management, right? So, for instance, even in a hostile deal, right? A private equity firm, may raise some equity, raise a lot of debt, take over a company, and their management team gets a piece. So they get a piece of the return or a piece of the company, and the management team they bring in gets a piece, and that's their incentive. They may take that instead of a large salary or whatever, but that could be a management team that's getting brought in to replace existing management. Because the reason the company is being bought out, again, may be to replace management. So again, just in terms of anatomy, leveraged buyout is typically involved in purchase of the entire public stock interest of the firm. Again, so that means that all the shares that are floating out there now will be in the hands of one owner or group of owners. And this company will typically no longer be publicly traded. And so typically, hence the name leveraged buyout, the transactions are heavily debt financed. A lot of times you actually use the cash on the books of the firm in order to buy it. So, what will happen is you'll see a company that's undervalued, and what you'll say to yourself is, well, I can raise a lot of debt to actually to buy this company, because I know that the cash that I need to pay down some of the debt, or at least a good portion of it, is actually sitting on the books of the company I'm about to own, right? So, it's kind of like, it'd be sort of like buying a house that you knew there was gold buried in the basement of, Even if it was a house you couldn't afford, you can borrow the money temporarily to buy it, because as soon as you own it, you're going in the basement, digging the gold up, and you're going to pay off the house, And so that's kind of how cash is on the books of a potential acquisition target, It's something that's very attractive, if you see an undervalued public company with a lot of cash on the books, it's going to become very attractive as a potential buyout target, because that once you get in there, you can work it out. Okay, so as far as the specifics of the, of the debt that's used and the other instruments that are used, there's going to typically be a lot of layers, and so when we look at, these deals, there's going to be equity put in, which is almost like the cash that the LBO fund puts in, or the cash that management puts in to buy a company out. But then there's also going to be layers of other types of debt. You're going to see senior debt, subordinated debt, convertible debt, and preferred stock. And we'll discuss a little bit about each of these. But one of the most important elements, and again, when I was at Stonehenge, it was a mezzanine level financing firm. Basically, when we talk about mezzanine level financing, we're talking about everything that is in between, everything that's in between the senior debt and what's called the common stock of the firm. So common stock is like what you would buy on an exchange, And so, and the senior debt is going to be, just standard bank debt. So there's a middle layer, a mezzanine, just like the mezzanine of a theater. It's that middle, you're not up in the balcony, you're not in the orchestra,